The governor spent years promising Florida was boom-proof. Orlando is now collapsing at one of the fastest rates in America. Contract cancellations hit 19.4%, one of the highest in the nation, and home values are dropping 2.6% year over year, while inventory shoots through the roof. This isn't a correction. This is a contagion. In April 2024, a retired couple from Maitland signed a contract on a single-story ranch listed at $540,000. They put down a $15,000 deposit, most of their liquid savings. 3 weeks before closing, their insurance carrier withdrew from Florida overnight. The replacement policy? $9,100 a year with a $10,000 hurricane deductible and water damage excluded. The lender refused the loan. The seller refused to release the escrow. Mediation dragged on for weeks. They lost the entire $15,000. And the insurance companies? They're already gone. This is Orlando, America's tourist capital, the city that promised endless opportunity and warm weather retirement dreams. But beneath the theme parks and palm trees, a financial disaster is unfolding. And the governor, who celebrated Florida's real estate boom, now faces a crisis he can't explain away. In 2019, Orlando's housing market was predictable. Median sale prices hovered just under $280,000. Inventory tracked closely with demand. Homes rarely sparked bidding wars. Buyers could negotiate, take their time with inspections, and secure 30-year fixed mortgages at rates around 4%. Migration from the Northeast and Midwest added roughly 1,000 new residents each week, but the market remained balanced. Most neighborhoods featured modest single-family homes and condos with prices that kept ownership within reach for middle-income families. Then the pandemic hit in spring 2020, and Orlando transformed overnight. Remote work eliminated geographic constraints. Workers from New York, Chicago, and Boston poured in, flushed with cash. Bidding wars became routine. Agents described listings that drew a dozen offers within hours. The median sale price shot past $320,000 by early 2021, then surged to $390,000 by summer 2022, a leap of nearly $110,000 in just 2 years. That's enough to buy a Lamborghini in cash. Mortgage rates under 3% poured fuel on the fire. Investors and flippers joined the chase, snapping up condos and single-family homes, while new construction couldn't keep up. Builders reported waiting lists stretching months. Brokerage meetings turned into celebrations of record deals. Brokers hyped Orlando as crash-proof. Local radio ads promised instant equity and urged buyers to act before being priced out forever. Every number tells the same story: collapse. But beneath the frenzy, warning signs flickered. By mid-2022, the average Orlando household needed to spend nearly 45% of its income on housing to buy at the median price. That's not sustainable. That's suffocation. Affordability slipped further out of reach, setting the stage for the collapse that would devastate thousands of families and investors who believed the boom would never end. Mortgage rates climbing from under 3% to over 7% by early 2024 added another crushing layer. A $400,000 home that once required a monthly principal and interest payment of about $1,685 now demands nearly $20,700, a 60% jump in just 2 years. That's an extra $1,000 every single month, forever. The math no longer works for thousands of families. Lenders tightened standards, wary of approving loans for applicants already stretched by rising insurance and property taxes. First-time buyers found themselves locked out completely. For the large part of the past year and large part of the last 36 months, interest rates hovered in the 6.8% to around 7% range. There are fewer buyers in the market, fewer excited people willing to put up their cash. But the rate hikes alone didn't break Orlando. The math stopped working, and nobody wanted to admit it. What shattered the market was something far more sinister, something that couldn't be refinanced or negotiated away. Then the insurance companies started disappearing. Insurance agents spent 2023 and 2024 fielding frantic calls as premium notices arrived with eye-watering numbers: $7,500, $9,200, even $12,000 a year for a standard single-family home. 7 Florida insurers, including FedNat, St. John's, and Southern Fidelity, went insolvent in just over a year. More than 400,000 policies were canceled or transferred, leaving the carriers that remained to pull back sharply. That's nearly 500,000 families scrambling for coverage that no longer exists. The state's insurer of last resort, Citizens Property Insurance, became the fallback for thousands. But Citizens began reducing its policy count, shifting more than 330,000 customers to thinly capitalized private carriers through forced depopulation. These new policies came with steep premiums and limited coverage, often excluding hurricane or water damage entirely. They're essentially worthless for the very disasters Florida homeowners fear most. In Orange County, non-renewal notices hit nearly 3% of all policies each year. The hardest blows landed in zip codes like 32789 and 32822, where entire neighborhoods suddenly found themselves uninsurable or facing deductibles over $10,000. Buyers under contract routinely saw their quoted premiums double or triple before closing. Mortgage underwriters now require binding insurance commitments before approving loans. Deals collapse when agents can't secure a binder, sometimes days before the moving truck arrives. By early 2025, internal brokerage reports tied 12% to 18% of all contract cancellations directly to insurance failures. Some zip codes topped 25%. By early 2025, 12 to 18% of all contract cancellations weren't about price. They were about fear. The dream didn't die at the negotiating table. It died when the insurance bill arrived. For many Orlando families, homeownership didn't end with a failed inspection or a low appraisal. It ended when the insurance bill revealed the true cost of living in a state where climate risk and carrier exodus have made coverage financially impossible. Florida sold itself as the escape. Now families are escaping Florida. The Maitland couple's agent assured them the numbers penciled out. The initial insurance quote of just under $4,000 fit the budget. They set a closing date and started packing. 3 weeks before closing, the insurance agent informed them that the carrier had withdrawn from Florida effective immediately. The only replacement policy available came in at $9,200 a year, with a $10,000 hurricane deductible and water damage excluded. The lender refused to clear the loan without full coverage. The couple scrambled, calling every agency in the city. Each quote came back higher, or was denied outright due to the home's roof age. With the insurance contingency period expired, they faced two impossible choices: accept the unaffordable policy and stretch their fixed income to the breaking point, or walk away and forfeit the $15,000 deposit. They chose to back out. The seller refused to release the escrow, citing a missed deadline. Mediation dragged on for weeks before the couple lost the full deposit, erasing years of financial security. Local agents report dozens of similar cases since the start of 2024. Most involve older buyers blindsided by insurance shocks late in the process. These aren't statistics. These are life savings, erased. By early 2025, the mood inside Orlando's top brokerages had shifted to outright alarm. In May, over 30% of pending deals collapsed before reaching the closing table, a figure that dwarfed the previous high of 19% set during the post-recession years. Nearly 1 in 3 contracts was falling apart week after week. Senior brokers described chaos where lenders balked at ever-widening appraisal gaps, refusing to bridge the $25,000 or $30,000 difference between contract and appraised value. One veteran agent with 3 decades in Orange County real estate put it bluntly, "I've never seen this many walkaways. Most are due to insurance. Either the property can't be covered, or the premium comes in so high it kills the deal on the spot." In April, the cancellation rate hit 19.4%, compared to a national average of just over 14%. By June, zip codes 32789, 32822, and 32837 top 25% failure rates. And the inventory? It's exploding. Orlando now has 14,000 active listings on the market, the highest level of supply going back at least 10 years. That's 50% above the long-term norm. By mid-2025, active listings surged nearly 80% for condos, and more than a third for single-family homes compared to the year before. Condo listings alone topped 3,500 units, the highest since before the pandemic. Builders who once raced to keep up with demand now find themselves with rows of unsold homes. Projects slated for completion in 2024 were quietly paused or shelved. A leaked email from a Lennar spokesperson described the company's Orlando pipeline as overstocked and undercontracted, citing a 40% drop in new reservations since the start of the year. D.R. Horton's regional office deployed incentives, mortgage rate buydowns, free upgrades, even cash at closing to move excess inventory. Fewer takers each month. The governor spent years celebrating Florida's real estate boom and touting the state as a refuge from high taxes. He now faces a crisis in Orlando that threatens not just the housing market, but the entire regional economy. State legislators passed insurance reforms aimed at keeping carriers from fleeing, but failed to address the fundamental problem of climate risk. Premiums continue to climb, coverage continues to shrink. The governor's response has been to blame trial lawyers, insurance fraud, and assignment of benefits abuse for the carrier exodus. Those explanations ring hollow for families losing deposits. The governor promised stability. Now he's overseeing a collapse he can't control. Inflation remains the biggest threat. Interest rates, insurance premiums topping $7,500, and mortgage rates doubling to 7% have priced out thousands of buyers. The state that marketed itself as America's escape hatch is now a cautionary tale. The Sun Belt promised endless summer, it's delivering an endless fall. Orlando's crash isn't isolated. The same pattern of insurance chaos, elevated mortgage rates, and buyer retreat now plays out across Texas and Arizona. In Texas, contract cancellations surged to 22%, nearly 1 in 5 deals collapsing before closing. Investor purchases in Phoenix fell 36% year over year, the sharpest drop since 2015. Institutional buyers slashed acquisitions by more than a third in both Dallas and Austin. Analysts point to rising insurance costs, stagnant rents, and uncertainty about future appreciation. The contagion spreading from Florida isn't limited to coastal markets. It's redefining what constitutes a safe real estate investment anywhere in the Sun Belt. This isn't Orlando's crisis anymore. It's America's warning. The investors who invaded Orlando and other parts of Florida during the pandemic drove prices to unsustainable heights. Now the big collapse is here. People wanted to leave high-tax states, lockdown states, crime-infested states, but the inflation, the insurance crisis, and the math breaking down have turned the dream into a nightmare. Orlando's housing market is collapsing. Home values are dropping down 2.6% year over year. America's tourist capital is transforming from boomtown to cautionary tale. This isn't the Orlando you've been promised. Climate risk and carrier exodus have created a new reality where coverage is financially impossible, and the governor who celebrated the boom now watches it burn. Can Orlando recover, or are we watching a permanent repricing of the American dream? Subscribe so you don't miss the next shocking chapter.